Good morning, everybody. Welcome to the Flow Show. Here we are, Fed Day. All the talking is done. If you don't know every single opinion about the Fed today, then you probably shouldn't be trading. It's been spoken about long enough, often enough. So now it's all about what they do and how we trade and react to it. Morning, Kay. How you doing this morning?
Good morning, Ryan. Good morning, everybody. Yeah, I mean, as usual, I'm amazed about the lack of respect of those FOMC people to come up with their decisions right at our dinner time. I'm gutted really, but so be it. We'll be ready.
Yeah, we will be ready. Hopefully, as ready as we can be, which is always to make sure we're managing our trades and protecting our accounts first and foremost, and worry about the profits after that. Right, let's get through the headlines and then we'll go over some prices and whatnot. Morgan Stanley have joined the long list of banks and analysts cutting China's GDP or their China's GDP forecasts. They have cut their forecast down to 4.6% for 2024 and 4.2% from 2025. A lot of these banks shifting their growth forecast from up near 5%, much lower. Over in Japan, we've had a bit of data out overnight. Some good, some not so good. We've had machinery orders, core machinery tool orders for July coming in soft at minus 0.1%. We've also got some trade balance data there, which is less of a deficit, but as you can see from those export and import numbers, activity has fallen back somewhat. Might just be a bit of a snapback because we've had some pretty healthy numbers recently. There is still activity, but if you just base it on that, then it's not as good looking at that side of things. What is still okay is that the Japanese government's latest economic report or assessment says that the economy is still in moderate recovery. They've kept their assessment unchanged from August, so things are still ticking along as far as the government are concerned anyway. Over in the Eurozone, over in the Eurozone, that's where France is, isn't it? Yes, Bank of France has done something surprising for a Eurozone country. They've actually raised their 2024 growth forecast to 1.1% from 0.8%, apparently following a national accounts revision. We're obviously in September, so the latter part of the year, so these forecasts become largely moot because we are getting close to the end of the line. They've left their 2025 growth forecast unchanged 1.2%, but lowered 2026 by a pip to 1.5%. Bank of France's Villeroy, ECB bod, said the ECB is likely to continue to cut rates. And then speaking on the French situation, said that they need to raise taxes. CPI data out from the UK this morning, largely as expected. Headline CPI coming in 2.2% as expected as per last month. The core confirming a rise to 3.6%, up from the 3.3% seen last month as well. Still positive numbers coming in pretty much all the CPI measures there. PPI a little bit different. Some negative numbers there, more so than expected, both on input and output prices. So that sort of counters a bit some of the stickiness in CPI, that there are still some disinflationary pressures in other areas. Obviously, PPI will feed through to CPI at some point. It's a lagger. Or CPI is a lagger of PPI, not a leader. As you can see there, retail prices still looking pretty sticky there. So nothing in that data to get the BOE too dovish about things. In fact, rate futures implied a 28% chance of a rate cut tomorrow versus around about 37% before all that data. So we've had seen a little bit of softening of cut expectations there, but they were pretty low anyway. don't expect the BOE to cut tomorrow, and all we're going to be looking for is how those votes potentially show when the next cut may come, whether it's close to a done deal or whether they're going to give themselves a little bit of room. Okay, anything about that CPI data this morning that's tickling your fancy?
No, what is it? The services PPI is still has ticked up a little, so that should keep them on the holds side. I would not disagree with what the market is thinking right now. I thought there was a bit of a risk for them to go if CPI would have printed a tad lower. But no, this is normally a hold pattern. I still wouldn't completely put the risk at for a cut at 0, and even depending on what the Fed does today, if they really go gangbusters on big cuts and things. But you know, independence from each other goes as far as it goes, really. But no, this is hold. These are hold data.
Yeah, pretty much. And at least we know what it is going in. So if they do cut, it would be a bit of a shock to the market.
Yeah.
So we know where the big price risk is anyway. Otherwise, probably going to move through that pretty quickly, much like the ECB last week. Right, going back to the US, or going over to the US and yesterday's data. Obviously, retail sales was the highlight, and it wasn't really much of a report in the end. We were looking for headline sales to come in a touch softer at minus 0.2, came in a positive 0.1. Some of the other numbers A-OK as expected on the control group, which are like core sales, take out the other bits and bobs. Some little misses of expectations, but otherwise there or thereabouts. I think the wider take from the retail sales data, as far as the Fed's concerned today, is that it was no disaster. So nothing there for the 50 basis pointers still floating around in the market. We did get some more soft landing data later on. Industrial production, healthy 0.8%. Manufacturing turning around a negative as well, up 0.9%. Capacity utilization rising as well. So again, more good data there. Business inventories, not sure why that's red, because it was a positive number, coming in up 0.4%. Retail inventories, are they on there? Yep, there they are, up 0.5% as expected. So again, positive numbers for inventories, which shows that activity is still ticking along. If we see inventories coming down or turning negative, that can be a sign that activity will be slowing, because no one's building up stocks. They're eating into stocks rather than keeping replenishing it. So that's how inventory data should be viewed. NHAB housing market index coming in at 41 from the prior 39. So as I said, more soft landing data, less 50 basis point cut data for the market to chew over. Over in Canada, CPI numbers there, and a whole set of soft numbers, depending on which metric you're looking at. Headline CPI coming in at 2%. One of the 30 different other measures coming in softer. The common CPI coming in at 2% lower than expected. The BOC core number dropping to 1.5%. Negative numbers on the monthlies. These metrics all coming in lower than expected in some cases, or in both cases, and lower than last month. So that keeps the Bank of Canada on its dovish stance. No need to change that, and they're justified by keeping it that way. The swaps market in Canada has increased the odds of a 50 pip cut. Everyone's jumping on the 50 pip cuts now. It's now 50-50 chance, well, 52-48, close enough to 50-50, on whether they go a 50 pip in October. That's up. The 48%, isn't it, was up from 45% before the data. Okay, they don't need to go at 50 really, do they? Considering they've already done 325s and are going to remain on that course.
No, but it's the same question with all the central banks. They don't need to. But then you have a comment by McClem saying that he's ready to. Roger spoke last night. She's still not done fighting inflation as we may expect. She's more on the hawkish side of the Bank of Canada governing council or board. Yeah, but the thing is just it's a number. Those are numbers that confirm that they are going to continue to cut. Okay, so this for those trading the Canadian dollar, it's a bit logic that they continue to price in cuts now. Is it a 50-50 or so? That is the market moves like the market moves, and I wouldn't want to stick a probability on it for the 25 or 50. For me, it just confirms that they will continue to cut, and that's it.
Yeah, and we've got to remember that rate moves don't impact the economy for several months, and that needs to be known. You're not going to get a rate cut today and see CPI affected the next month, or stop slowing, or the economy affected the next month. It's a slow process. So part of the reason is that all these central banks have got the confidence inflation's coming down, so they can start bringing rates down. And the hope is, and it is nothing but a hope trade for all these central banks, is that they put the brakes on CPI falling, so they soft land inflation, if you like. The big problem, which is going to be the future problem for the months down the road, is if inflation goes through their targets, and then you'll see the market getting all dovish again and moaning about central bankers being behind the curve and having to chase it lower, much like when they had to chase inflation higher. But that's the next trade and the next dilemma that central banks are going to be facing. But just to remind that the BOC has cut 3 times now, and we're probably not even really starting to see the effects of that just yet. And the Fed are going to be in the same boat. And that's one reason why they may go at 50 if they feel that they need to stay in front of it rather than chase it later on. But anyway, that's for later on. As I said, all the opinions are now done and dusted. Yes, Rogers was speaking, and basically what Kay said, she said the inflation battle isn't over yet, and that policymakers still want to see more progress on core inflation measures, even with the primary measure of price pressures back to the central bank's 2% target. It's the same old accounting trick. Headline CPI may get down to target, and then they'll make it all about the core if it's not. And as we know from most central banks, as we saw from the Fed, the Bank of England, core numbers are nowhere near target yet. Though the Bank of Canada is pretty much on it, particularly that BOC core, which is below it. Right, moving on. We've had this stuff going on in Lebanon, the proper James Bond shit with this this pager stuff going on over there. No need to go into all the details of it, but there was a sources piece out later on saying that senior Israeli military officials are apparently preparing for a third Hezbollah war, which is expected to begin almost immediately. So that event, potentially the start of another step up in hostilities between Israel and Hezbollah, aka Iran. So that is something we need to keep an eye on for risk trades, how that develops over the days ahead, and indeed what response comes from Hezbollah. That might mean that risk trades need to be kept an eye on over weekends and stuff. In politics, US House Speaker Johnson says that the House will vote today on a 6-month stopgap funding bill, which is tied to the SAVE Act, whatever that is. Now, this is a guy who's been proposing this vote or this bill, this stopgap, which is previously said wouldn't pass, it wouldn't get the votes to do so. It's believed that he doesn't really have the votes for this to go through. So this is more just a first cannon shot, if you like, in this problem. We've got some 2 weeks until the deadline for when funding runs out. So we're probably going to get a lot of horseplay going on now, various votes being added, taken away, chopped about, whatever. But the clock is ticking on that, but we do have a vote today. Now, going on to talking about the Fed, and particularly more so what the market reaction is going to be and likely to be. Firstly, we had JP Morgan CEO Dimon saying that a Fed cut won't be earth-shattering in expectation. So he's not seeing a lot there. Now, he's in charge of a bank that's still holding on to a 50 pip cut today. So saying it won't be earth-shattering, I don't know. There's a lot of other aspects that say today could be a bit earth-shattering. One of those is in Fed Fund futures, where the October contract apparently has jumped to the most extreme level of any contract since they started the contracts in 1988. A lot of people are piling in to 50 pip rate cut trades, which tells you that if it's not a 50, and unless a 25 is uber dovish, there is going to be a big move in markets. That's going to be a rally in yields. That's going to be a rally in the dollar, and a sell-off in those Fed futures. So we are facing a big reaction, okay, over this FOMC. I don't think, Kate, we've quite had one that's been such a frenzy. Not even in the hype cycle when we were deciding 50s and 75s. I don't think we had this level of frenzy. Why have we got it now?
No, Ryan. People compare it to potentially rate moves back in the 70s and the 80s, because there's so many variations possible. We are starting from the highest level in rates in a very long time. We are in still accelerated cycles on everything, as we have seen. Yeah, we can argue that they kept the rate still for quite a while, but we are still, as we see also from market reactions in accelerations on a lot of things, and that is why it's such an important one. The important one this time as well is we are expecting a clear message on whether Powell and his mates are willing to support the jobs market over the risk of perhaps sparking inflation again. So we're expecting something here today. He's going to have to tell us, and if he doesn't, that's going to be the disappointment. But he's going to have to tell us whether they are now saying like, okay, inflation is sort of where we want it to be, because they also said enough times that it has to go to 2%, but not exactly stick at 2%. But there's a lot of interpretation there. But he's clearly said that they don't want the jobs market to deteriorate. So now we are waiting to see to what extent they are with a jobs with an employment rate which is historically speaking not that high, but we are waiting to see if they think that there is a real risk here for stuff deteriorating. So that is why it's such a big event, because whatever they decide today is, or should at least, tell us what their mindset is going forward, and that is the most important thing. And I kind of agree with some commentators and like Diamond or Dalio saying it doesn't really matter whether they do 25 or 50 today, it is what they will do later. And that is what we need to hear from Powell, or there's going to be a lot of disappointment. So why it has been hyped up is because the market has traded in the way of saying now they are ready to support. Now there's no need for those yields to be higher. We're expecting them to start to cut a pretty severe a pretty severe cutting cycle. And if it doesn't give that to the market, that is going to create equal volatility. So that is why it's all so important today. And we usually say like, well, the market is hyped up and options are not pricing that much volatility. But today is slightly different, right? We are looking at something that could define the markets for months to come, right? So that to me is important. We may argue that the options market is actually still not pricing in an overly big move, because if you look at the overnight straddle is just above 60 pips. It's 1.5 times what we usually see over data. So it is bigger, but it's still not something overly big. But then options are options. It's not like all the time telling us exactly what to do and what to expect. But yeah, for me, it's a big thing today.
Yeah, absolutely. And we've been heading to this all year. We know the Fed has been heading towards cuts. The market has been playing the guessing game of when it's going to be, and now it's got the when it's going to be. It's playing how big it's going to be. It's always the case that the market is far too dovish, gets far more excited on the dovish side than it does on the hawkish side, and this is just the culmination on it. And it's good and bad for two reasons. It's good because we're getting all this volatility, which should give us good volatility to trade. It's potentially bad because if the Fed managed to give a clear path that the market is happy with going forward, then volatility is going to come lower, which isn't so good for trading. So it's one of those double-edged swords. We love the volatility. We don't want it too volatile, but we don't want it too quiet either.
And also, Ryan, what we can't forget is that it's the Fed. It's not South Africa Reserve Bank. Doing what they do on the rand. It's the Fed. The Fed is and the U.S. market is the biggest market in the world. It's the port of the harbor for massive investments. So that is why today is a big thing when they start to shift gears towards one or the other direction. It was the same when they started to hike rates. Like, look back and you will see why it is a big thing about the Fed rate path. Just look back at what dollar yen did when the Fed when Powell actually started to hint at hiking rates. Dollar yen went and during the rate cycle, dollar yen went from 110 to 150. It is a big thing, okay, for many markets. So for this one, I would really say don't underestimate what is potentially to come today.
Yeah,
and the days to come, and the days and potentially weeks to come. This could be, if they are very clear, this could be a path that they are giving the markets. Huh?
Yeah, and really though, you have got to think about the context as well. Yes, we had hiking from basically 0 up to 5.25%, 5.375%. We're not going to be going back to 0. We're potentially going to undo half of that rate move, or less than half if neutral's around 3% or something. So we shouldn't see the same scale of move in the dollar, and I'm just talking about the dollar, not dollar yen per se. We shouldn't see the same scale of move down because we're only talking about 200, 250 basis points of cuts all going to plan. Obviously with dollar yen, you've got the additional BOJ hiking as well in the mix, which throws that out the window. But we've got up 5%. We're not going to come back down to 0. So it's not going to be a complete reversal unless things start falling off a cliff, and then that's a whole different kettle of fish. So you need to manage your expectations. We shouldn't be moving 1,000 points on 200 pips of rate cuts. Okay, it's not the rule of thumb. It's not how things really work, particularly when we're not in a financial crisis. We're not in any other sort of crisis at the moment. We are just in a period of central banks normalizing rates. That shouldn't bring huge, massive moves, but markets are a different kettle of fish to when you and me were sitting at desks, Kay. More goldfish thinking, more algos, robots.
Yeah, That's the
Don't put
thing,
a human thought.
Ryan. We've seen this evolution. Um, just take for instance bank desks. We used to be when I was in one of the UK clearers, we used to be 30 spot FX traders between the three desks, and I guess there must be 4 or 5 left, and the rest is done by machines. Machines don't necessarily think. Machines don't necessarily give liquidity. Where voice traders were like, or human traders were more like, when a move is getting a little bit exaggerated, giving liquidity to the market and going stabilizing the markets. Now it's the opposite. Machines don't think. If they sell whatever price they get, whatever liquidity they get. They don't think about stabilizing markets. But that's a bit simplifying everything. We can't also forget that in the global scheme of things, we are still. If you look at an economic cycle, for instance, a normal one that we could identify before, we are still inside one cycle. If you compare, if you look at when the pandemic struck in 2020, we are 4.5 years later. We are still inside the norm, what was normally accepted as an economic cycle, which was 7 to 8 years. We are still inside it, and we have already had 3 economic cycles in between. And that is also something we can't forget. Money moves faster and in bigger droves. So yeah, that's why we have this increased volatility. But I would add, the increased volatility is especially seen in instruments. Take the yen away from things, but for a minute. But if you look at all the rest, we FX, like look at the euro dollar, for instance, it's still a very low overall volatility on the euro dollar. Yes, we had moves from 123 down to 120, but look at the moves that we had over the past year and a half. You're talking about 7-8 big figures, which is nothing.
Yeah, exactly. Obviously, we did have some big volatile moves. This was in large part.
Yeah, that's the big rate hike cycle. Huh?
Yeah,
that
exactly.
is one that where I'm saying this has the potential to be the driver for the next months. If you look at what the move was on the US rate hike cycle, and all the other countries to a slower degree for Europe, but all currencies have done exactly the same. There you have the proof that the US market is the biggest market, because when the Fed hikes or cuts and the market takes it and goes with the flow or front runs it, that's where really things are on the move. That's why I'm saying we are at the potential start of a new cycle. So watch out, because this could be the start of a new trend also for the dollar.
Yeah, and that point's magnified here. This is euro dollar. This was the Fed hiking, all the while the ECB was hiking as well. So even with both of them hiking, this is what we got in euro dollar, which just again shows you the power of the dollar. But then look at this in context. We've pretty much undone half of that move, nearly 2/3 of that move. So one could say, okay, well maybe we are a bit here. How much higher can we go all the way up to 122 on the Fed cutting with the ECB cutting? It's possible, but I think everything really needs to turn south to get that. So you've got to think where we might be limited to moves at the moment. We've sat in this range through the end of hikes, the start of cuts, all the data softening, everything. We've sat in this quite tight 600-700 pip range. Okay, is this the day that we're going to break out? It could be. It could be the day we break out. But sitting in now and trading now, you've got two options. You look for the breakout, or you look for the levels to hold. If the levels hold, you know what to do. If the levels break, you've got to be careful, see what happens. Are the breaks going to hold? So really today, well, for me, how I'm setting up trading anyway into this is I'm going onto my big clean charts. I'm looking for the bigger levels. I'm looking for the points that says, okay, if the Fed are going to do something big, these are the levels they've got to break. or these are levels that are going to hold. And if they break, then I'm going to see what's next. If we break up higher, I've got my sight set on 115. I'll probably trade that if we see it, no matter what happens, because it is a huge, huge level. Well, obviously, if the Fed are saying they're going to cut 100 pips next month, then that's a different kettle of fish. But all being equal, that's where I'm planning. I'm not interested in pissing around here, whether it's going to trade 110.50 or 111.30. Okay, don't care about that right now. I'm going to watch the prices, pick my levels, and those are the places I'm going to trade. So as I said at the start of the show, all the opinions are done. They count for nothing. My opinion counts for nothing, and with all due respect, Kay's, Blake's, everyone else's, our opinions count for nothing. It's all about what the Fed do now. And for all our opinions, it's all about what you do. I don't want to come in tomorrow and hear that someone's done an I think trade and gone offside by 300 pips and lost 3-4%. You shouldn't be in that position. You should not get yourself in that position over this. You should be informed enough now to know that if you're going to lose money, you do it in a controlled way. If someone comes in tomorrow and says, "Oh, I tried this trade and I lost 1%, but I kept my risk management, I kept my trade management discipline, I lost 1%, I was prepared to lose 1%," that's fine and dandy. That's controlled. I don't want to hear any horror stories tomorrow, because no one should be getting caught out, irrespective of how big an event this is. So, as I say, go through your wider charts, knock out all the short-term stuff. There's lots of levels to look at, lots of range edges to look at. There's one in euro dollar. Another one, I've just closed out my dollar CAD short 136 because we're 15 pips away in my trade. So I'm not staying in a small position and having to worry about that distraction over the Fed. What am I going to look at here in dollar CAD? We've got these two areas, 136, the area, the zone, and we've got that level 136.50, both sort of pivotal levels, but we're really close. So I'm going to ignore them over the Fed. If we break up, if there's something less dovish, we're going to head up probably towards these highs up here, because it's going to be potentially that volatile. So I'm going to look up there, up into these highs. Can the market break it? If it can't, then I'm going to think about trading to stay in the range. Same for the downside. If we get something uber dovish, we got some levels below, the big levels down at 132s, 132.5s. Okay, the bottom of this long-term range. And if we get down there, I might deem it a decent stretch point to try a counter trade. I don't need to get too tied up in the noise. What was interesting yesterday is what went on in stocks. We got right up and tapped it literally on the nose, that prior high. Let's come into something a bit shorter term. Right up there against that prior high, we nailed it, as I say, pretty much on the dot. I don't know if we ticked above it, maybe by a pip or so, but we held it and then pulled back. So this one is still in question. Again, there is a high risk in stocks that you get a bust out that's a fake. Okay, a bit of a fake out. So be careful. If you're long this one and you get a quick bust through, then maybe take some profit just in case it is a fake out and reverses. Because if you take some off the table and it does, then you've done well. If it doesn't reverse, then fine, you run the rest of it as high as it goes. But again, I want this one to break under circumstances that don't involve the Fed and data and everything else. But this one's in the balance. Likelihood is that even if we do see a decent sharp pullback, it's likely to become a dip to be bought again. But the problem with the Fed is this is probably not, and I don't know if, I assume Kay's going to agree with me, it's not going to be a one-day show, okay? Whatever news comes from the Fed is probably going to last in the market for a few days, maybe even longer, because there's a load of positioning over this one and a big adjustment for the market to make, either on the undovish side or the dovish side. So don't go fading stuff straight away, because it might run a bit further. You share those thoughts, Kay?
Yeah, of course. Depending on what they decide, that's what I said. It has the potential to drive this market the potential is there to drive the markets for weeks and maybe even longer. I mean, imagine that they really come out saying like, okay, unemployment rate is at the top end of our projected range. We don't like it. We want to do something about it. We cut 50 and we are ready to cut another 50 and so on and so forth. We are ready to support everything until everything is sorted and everything is doing fine. I mean, then who are we to go and stand to go and stand in front of the markets if they would decide upon such a thing. Same thing can happen to the other side. If they say like, well, come on, I mean, the unemployment rate is only at 4.2%. What are you guys panicking about? We do 25 and we will go in only 25s, and we are not even sure that we go again the next meeting. Okay, that will be the dots telling us, and then Powell over the meeting. But that could also drive the dollar in that case back up for at least sessions, multiple sessions to come, because that would be telling the markets that they're basically wrong. So there's a lot of variables today, which could really drive the markets for multiple sessions at least.
Yeah, and it's really in two parts, and we've been speaking about this for the last few weeks when over NFPs and everything else. Okay, there's two aspects of play. We've got obviously the 25, 50 pip game being played. That's more by the short termers. And as we saw last week, irrespective of the data, we saw yields coming down in the short end. Even when we got good data points, even when the dollar stopped falling, there is big money, or has been big money, getting into the Fed cut trade. They're not trading 25s or 50s, they're trading the whole cycle. Okay, so any rally you get in yields, any rally you get in the dollar is likely to be hit at some point, because it doesn't change the narrative that whether the Fed cut 25 pips, they're still going to be cutting. They're still in a cut cycle. Rates will be coming down, whatever. So any rally you get in yields is just going to be, a bit of a gift for those who are trading a Fed cut cycle. Okay, so you might get a rally up 380s, maybe even towards 390s. Okay, and it may last a few days, and the dollar may rally with it. But at some point, those who have been doing this all the way down here, buying bonds, all this move here, they're going to come in and go, actually, you know what, you've taken that too high, and we're just going to get load up again or put more on. So know the wider pictures, the same as looking at the wider charts. Know the wider picture for the fundamentals and what's happening with the Fed. They are cutting rates, whether it's 25s, 50s, whatever. They are cutting rates, and they're cutting rates down to 3%, 2.5%, whatever it is. And if that's what they do, then yields, particularly two-year yields, are still too high. If we take 3% as a neutral level, we're 60 pips too high. Now, it may seem like a no-brainer to go in and pile into bonds, but as we all know, bonds incorporate other things into the rates rather than just a straight interest rate trade. So, I wouldn't be surprised a few months down the line, we may see bonds 320, 330, somewhere like that, on the back of the Fed moves. So know what the trend is, the wider trend. That's the one you concentrate on, outside of the noise we're going to get today with 25s and 50s. Okay, I've been yabbering on. I'll give it over to you, mate, so you can give us any gems you've got for today in trading the Fed, mate.
Okay, so let me start by making Dereji happy and show gold, because it's been one of those that's been traded quite actively over the course of the past weeks, as we know. We've broken up there. Okay, one thing to note here is that we ran into, and I may be off with a couple of bucks with the range here, but we ran into the top end of what would be expected when you do a range break. So this is just the range added on top of where it broke. So that brings us to, depending where you put it, like 90, 90, 94, 92, 92-ish. We ran into there, stopped there, did a bit of correction, which is all normal. I think that's going to be your level, which is important going over to the FOMC. And as I've said, there's variables, there's variable scenarios that they come up with. Now, imagine that we get like the extreme scenarios, and everything in between will likely also mean that gold is hovering somewhere in between those levels. Basically, the level is 90.93, 24.30 with 25.5 in between, I'd say. But imagine they go all like extremely dovish, like 50 and keeping 50 on the table and showing that the dot plots are somewhere for 2024 around 430, 440, or even below. That would be extremely dovish. And this is going to fly through. Okay, this is probably going to be on its way to 26 and a half, where I reckon that we really should start to think about, has this move now come far enough or not? I know people are already talking about 3,000. Let's take it one step at a time, as I always say. But I do think if they are really dovish, this market is just waiting for them to press the buttons. This is what it's trading like. It has to. I think there is room for disappointment. They could do 25, leave 50 on the table, but the fact of them doing 25 and showing a dot plot, which is not really telling us that we are going to go with massive 50s all the time, but leaving the door open on one perhaps, there could be a little bit of disappointment. Then we see what we have to do between 25.30 and 25.5, okay? 25.30. I guess there are going to be stops below, so watch out if you see a stop loss run below and then all of a sudden this turns around. Okay, this is going to be one of the dangers in all pairs, but especially I would say metals and things that have moved substantially. This is the danger in everything today, that we see a bit of a stop run and then start to turn around again. Okay. Take that into account as well. So I wouldn't rush into anything unless they are really extremely dovish. And then I think this one is really going on a tear. And I do think the same for silver. This is one where if they are particularly dovish, that is the 50, we leave 50s on the table because we really don't like what we start to see in the jobs market. And the market thinks like, okay, they are going to do, because there's two ways of interpreting that. There's the way of, oh, they know something that we don't. So the economy is really doing a lot worse than what we think. Then you see a knee-jerk reaction coming back down. But you can interpret it to the other side, and that is where I'm somewhere at. If they say that because Jay Powell told us they wouldn't tolerate or wouldn't like or wouldn't tolerate too much of a deterioration in the job market. So I may interpret a dovish Fed today as saying we will do everything we can to support the economy. And if the market takes it that way, then, as we know, this is an economic industrial metal. This could actually go on a tear, and we would be at we could go up to 32.5 pretty quickly in silver. This may even outperform gold. Okay. Obviously, we look at the dollar yen, but it's been a bit of a strange one. I think some people said like, yeah, we went to some here we went to some resistance also in the 142s. I'd really say the look at the wider levels in dollar yen for today. We also have the Bank of Japan on Friday, of course, but yen being such a volatile currency is going to respond to what the Fed does today. Okay, so and I would say like either you look at this 139.25, which is the nearest low here, and the 38.2, or you really take the pandemic low and then you end up around 138.75. It's 50 points apart. I think that's in the end right now it's close enough for government work. I might, if the market really reacts very hard, but if they don't open the door on more 50 cuts, I may give it a go if we get anywhere closer to those levels, perhaps. But remains to be seen. Okay, if they are really not as dovish as the market would like them, and come over very relaxed and say we're only going to go in incremental steps and not going to go any faster than that, then we have the potential here, because I don't think that Bank of Japan is ready this meeting to do much more than talk about the potential. Then this really could fly all the way up to 145. So be very careful today for the yen, because it is going to be potentially extremely violent in this pair. I'm actually not in a hurry to trade it.
Yeah, mate. I was going to add. I'm leaving that one well alone.
Yeah, I mean,
It's too volatile for me.
yeah, yeah.
To rely on levels and stuff. Even.
Oh yeah, but I'm just putting those levels because they show up. It would be interesting if that 139 and a quarter, 138 three quarters would show up at some point. Okay,
Yeah.
that would be really interesting, and then we see the reaction around there. That is what I'm thinking. Rather, I wouldn't touch it if it starts to fly, because I don't. I still don't like to counter trade all those. If it would start to rally and Bank of Japan all of a sudden slows down after the new LDP elections, who knows? We could be trading back up to 149. Who knows? So there's going to be a couple of other ones, of course, which are going to be interesting. We are closing in on the 68 figure a quarter. Okay, there's a bit of a Trump level above there, around 68.70, but we have seen the 68 and a quarter on the Aussie dollar show up. If there is a bit of supportive dovishness in the Fed, this is going to be tested. Okay, I think now we are ready. If the Fed gives us what the market thinks it may give us, we are ready for a decent retest of 68 and a quarter on the Aussie dollar. So if ever the Fed is dovish, that is one that I'm going to keep an eye on, because a break could see it go higher, because it will likely go hand in hand with a better risk environment as well. Cable, the issue, Brand, that we have in cable, and I know that you're very, very active in cable. The issue that we have in cable is we have the Bank of England tomorrow, right? And there's still a bit of uncertainty, especially, I would say, especially if the Fed is not too dovish today, then cable is likely one to leave alone until tomorrow's Bank of England, because the Bank of England is pretty much done on a hold. But if the Fed is not too dovish, are you going to buy or sell cable? If the Bank of England is on the same page and not too dovish with a hold, I wouldn't know really what to do. This is one where you really have to think about what the Fed does, and then straight away think about what the Bank of England may be doing. So, if anything, a not too dovish Fed could put 131 or so back under a bit of scrutiny, and then we see what we do here. But I've been saying as well in the room that if we get divergence and like a very dovish Fed and the Bank of England on hold, this could be in for a test of 134. Could be, because we have seen after today's CPI, market is pricing out more the potential of a rate cut tomorrow. And also we see sterling do quite well on the cross side. Okay, so dovish Fed, neutral Bank of England, this could be in for a serious rally. If they're both on the same page, perhaps a bit more range trading. What say you, Ryan, about that idea?
Yeah, no, well, I completely agree with that. Overall, for the dollar, I'm more a rally seller in the dollar than a dip buyer, I think.
Okay.
Because whatever happens, the Fed's going to be cutting, and so
yeah, I know, but the thing is, the market will need to reprice if they're not dovish.
Oh yeah.
And the bond market being such a driver, market being such a driver, we could be in for a series of sessions to reprice. It's really, I'm quite happy to be. I mean, I don't have any dollar positions as such. Okay, I've got a bit of gold, but I don't I'd rather look at it as a gold position than really a dollar position, and I'm like sort of mini hedged and still a little bit of dollar CAD. But
Yeah, cable 128s, 127s. I'll get interested.
oh, I would do as well, based on the fact that I still like sterling over a lot of other currencies.
Yeah.
And one that I'm looking at, and we are a bit divergent there between Ryan and myself, is if the bank, well, I mean, okay, this is going to react, this euro sterling, because it's going to react on the risk side of things, okay? So we know that cable is an accelerated euro dollar as well, and if risk gets hammered on the back of the Fed's decision, this is probably going to rally a bit if risk is doing better, and if the dollar is mildly sold off, this is probably going to go down. But I'm already thinking about a Bank of England that if they really stay neutral, I think we are going to be in for a serious test here of this 83, 85, 84, the figure. This is now the potential that I think that may happen, especially if the market is right in pricing out immediate cuts from the Bank of England. I tend to think that we are sooner or later in for a retest of this one. And I reckon that we've taken enough, or well, I at least have taken enough of your time. We can talk about other currencies tomorrow after the event.
Yeah, thank you very much, mate, as always. And yeah, all the talking's done from us here at the Flow Show. Tomorrow we will go over what actually happened, and hopefully everyone survived and indeed made money from it. So that's the main thing. So trade safe as always, people. Take care. If it's going to be too volatile for you, just stay out, watch the show, pick up the pieces after, and make sure you're all back with your accounts healthy tomorrow. Have a good day, everybody, and we'll catch you tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.